Welcome back to the Finance Corner. So, this is episode 9 in our series of Flipping Money Slowly with the Options Wheel. And we got a lot to talk about. So, there's a lot of updates since the last video. So, let's just get right into it. So, as you already know, we're the two tickers we've been playing around with was Coles and SMR. So Coles was actually recently down. We got assigned we wrote a put and got assigned like the first put we wrote back in like December or not December, January or February, and then we've been holding those shares ever since. So we're gonna talk about um Coles and my plans with that going forward, and we're gonna talk about SMR and my plans with that going forward, and we're gonna look into some technical analysis. But first, we're actually 6 months into the account that we've been or going on 7 months that we've been playing around with this account. So let's actually see some of the results. So I was actually looking, where is it? Where is the P&L? I swear you can see it if you just scroll down. I'm still not used to using Robinhood on the desktop. Always used to use it on my phone. All right, so it looks like we gotta go up here. We gotta look into, where is it? History. So here you get to see all the plays that I made. The one thing I want to see my P&L. Where do I find the P&L? Because this is every single thing that we did. Where do I just find the P&L? Basically, I can't. Basically, we're up around $942 just from the premiums collected and the plays that we did since the start of this account. And we started this account in early January, so the beginning of January 2026. And basically, yeah, we're up like 942, and we started the account with $7,500. So if you do the math out, that's about like a 13-14% return in the 6 months. And when you actually compare that, let's do that real quick. When you actually compare that to the stock market performance, I can actually say that I've been beating the market. Well, I've been beating the S&P, but not the Nasdaq, and we'll show it right here. So if we take the handy dandy ruler from the beginning of January, which is about here, January 6th, and measure that to the current price. No, that's 2025. I'm like, there's no way. All right, 2026, beginning of 2026 is right somewhere up here. Let me zoom in a little bit more. February, right there. So around here, you could see the S&P is up, call it 7% for the year. When you do that math out for my premium, I'm actually up around 14%. So I beat the S&P, or I'm beating the S&P, but if you look at the Nasdaq real quick, tech has been doing much better this year. Just as because of all the stuff with AI and building out the AI and the infrastructure around the AI. A lot of tech has been doing very good. Tech is up about 15%. So I didn't really outbeat or outperform tech, but we are outperforming performing the S&P. So let's look into what we've actually been doing. So as you can see, we got a lot of plays. We've been doing a lot of plays. I think the last thing I was doing, it's been a while now. Okay, so yeah, we activated interest or we activated margin just to be able to like get a little bit more contracts and but we're not over leveraging. I'm trying to be very careful on how much margin I'm actually using because we are playing with volatile stocks, so you don't want to actually get too caught up with being margin called. But I'm trying to remember the last thing that we did, the very last play. Okay, so yeah, here we are. Here we are. We did get assigned the shares. So we got assigned shares of SMR at 14.5 put, but when you calculate the premium, when you incorporate the premium that we got paid, our cost basis came down to about like $12.80 something cents. So that is our cost basis on that assignment. And then I've just been kind of sitting on my hands. Oh, this is what another contract I tried to collect to premium on. I think this is after we got the assignment. So I wasn't really trying to get assigned more shares. I was just trying to collect some premium. So as you can see, we sold two contracts at $40 or 40 cents. And you do the math out, comes out to $80. And then we actually ended up, oh no, that's another, oh yeah, I think I ended up rolling it. It's a 10-5 expiration. It's been a lot of moves that I've been doing actually. So SMR $13 put 6.5. So we got paid that one contract at $75. 13. Okay. Yeah, I remember that's what happened. So we actually ended up losing money on this one. So we sold this for 75 cents, and then around that time price was like dropped immediately. So June 13th, we wrote it on June sorry, we wrote it on June 3rd, and then it expired 2 days later. So we can actually just take a look real quick of the SMR price action. And then we're definitely gonna talk about some calls, but SMR has been kind of letting me down. I was convinced that we were gonna get a breakout of 14. So here we are. I remember saying, let me get rid of this here. So yeah, I remember saying how there's this gap here. I didn't really like this gap, and I remember saying how it makes sense how we can come back and like fill this. So we did that, and then immediately we ran up to the $14. This was the kind of what I was looking at when I was drawing out these tools here. So I had the Fibonacci retracement tool from this swing low to this swing high. And then once you incorporate the gap, this blue zone here, I'm like, all right, it makes sense that price can come back and fill that. And then we should kind of just take off from there. So we did exactly that for like a good week or two, where we bounced out of this range from $10 all the way up to 14. I thought we were going to break out from there though, but it looks like the market had other plans. Because as soon as we hit 14 and took out this previous high, we immediately dumped even lower. Immediately dumped even lower. So I didn't like that. And I think June 3rd. So yeah, we wrote the contract up here June 3rd, and then immediately after price started dropping, which is not what you want to see when you're selling a put. If you're selling a put, it's a bullish strategy. You want the price to expire higher than your strike price. So you can just go back here. My the price dropped well below $13, as you can see there. So $13 is like somewhere up here. And then by the time expiration date was, which is June 5th, on this big red candle, price actually closed at $10.50, well below $13. So we actually ended up losing money on this because we sold it at 75. By the time that it actually came down to by the time it actually came down and expiration date was there, we had to buy to close. So this is what we did. This is what we did. So you can see $13 put expiring 6/5, got paid 75 cents, and then $13 put 6/5, we had to buy it back at a loss. So as you can see, we ended up losing basically like $1 or $100 on it. Because remember, each contract is 100 shares. So you take $1 times 100. We got paid 75, but we had to buy it back for $1.76. But what I did was actually roll the trade because I wanted to basically buy more time. So once we captured that loss, we also sold another one for $1.91, expiring 6/12, $13. And then I think I ended up collecting $15 from that. So if you take the $100 that we lost from here and here, take $100 and then subtract the $15 that we gained from here, that comes out to about like a $85 loss. $85 loss. And then that left me in the contract expiring 6/12, where price was supposed to stay above $13. We never did that. As you can see, this candle right here, price is around $9.85 on the expiration date of that contract. So, we're kind of like taking L's in a way, like left and right. Like we're writing these contracts and they're going immediately in the money. It's not really what you want to see as an option seller. You want your contract to expire out the money so that you can just keep all the premium and then you're all happy and whatnot. So now I think that was another thing I did is I did another buy, I did another roll. Yeah, yeah, yeah. So we we bought to close the $13 put 6/12. This is another loss I think we took. Yeah, this is another, or essentially, because we got paid the $13 put here with a roll. We got paid $1.91, and then we had to buy it back to close it at $3.42. So that's another loss of like a dollar. I can't do that math real quick. A dollar and some change times 100. Um, Locked in that loss, and still we rolled it out again to the 18th. So we rolled it out another week to the 18th, and then we got paid $3.44 for that. So we can see on the 18th, price still failed to get above the $13 strike price. So as you can see for this particular contract, I just kept rolling it and rolling it and rolling it a week out to try to kind of like literally just kind of buy more time, and also to just I didn't want to get assigned those shares. So but it looks like we actually ended up did getting assigned anyway. So you see there's a short put roll here. We recollected the $2 and then we actually ended up getting assigned. I think this actually happened. Yeah, this actually happened at a um like overnight. I remember when they assigned this to me because I was like, I'm gonna keep holding it, and like even if it's out of the money or even if it's in the money, I'm just gonna roll it. But they actually assigned me before I even got a chance to do that. So so yeah, we actually ended up getting assigned even more shares. That's why I think currently we have 400 SMR shares. Um, but yeah, this is only for one contract, so it wasn't that bad. And now you can see we actually are using some of our margin. So that is SMR, and then Coles has been doing a lot. Coles have been doing a lot. Uh, we the whole time we've been kind of holding on to shares. So let's go over to Coles real quick. The whole time we were holding on to shares, ever since we got assigned back in like early January, we got assigned so early, it's not even funny. I got assigned so early that I ended up collecting two quarterly dividends for just holding the shares, right? So I believe it was somewhere back here. We got assigned. And then that's why I have these white lines here. My cost basis got dropped down to like $19. But we've been doing I've been selling calls and I've been collecting dividends. So my actual cost basis got dropped down even lower. We can see it here. So I've been selling, or when price came up to about my cost basis, which is 19 or lower than 19, I said I don't mind writing a $19 strike price because even if it's good called away, I'm still going to be break even or slightly in profit. So yeah, so we got paid 15, we sold three contracts, we got paid 15 cents for writing this $19 strike price. And then I think basically we ended up making like $38 on that. I don't know why I broke them into three separate like entries. I should have just sold it all at the 2 cents. But basically, if you take, what is this? $4 plus 3 is 7. $45 minus $7 comes out to about 38, 37, something like that. So I made about $38. That is going to be added into my cost basis. So now you take 19, mind you, $19. We can actually see it here. We can actually see it here. I think that's about all I did. Yeah. So we're around here. Let me go back to the main account real quick. You could actually see it here when I click on my actual cold shares. It'll say my cost basis is $20.05, but that's because of the initial put assignment when I got assigned back in like early January or early February. I wrote a $21 strike and I got paid 95 cents for it. So if you do $21 minus 95 cents, that's why our cost base is $20.05. But that's not including the dividends that we've been getting paid and the premium that we've been getting paid from writing calls against it. So the last thing I know, it was around $19 where my strike price or where my cost basis was based on the calls that we've been writing. But now when you incorporate the dividends, because if you can go back to our handy dandy history, so now when you incorporate, so basically we got paid the 38 cents from this contract here, 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 and here. So you take $19 minus the 38 cents. That makes our cost basis $18.62. And then we also got paid another dividend from Kohl's. You can see here. So if you put this into decimal points, now when we do our cost basis calculation, it's going to be $19 minus the money we made from these contracts. So $19 minus 38 cents because we made 38 $45 minus the 7, which is $38, but we got to put it in cents because we're calculating our cost basis now. $18.62. That's going to be our cost basis, and then we lower it even more because we got paid a dividend. So we're going to put that in decimal points 37. Our actual cost basis is $18.25 based off the most recent dividend. So actually what we're going to do now is 18.25. Our cost basis is here. 18 and 25. Call it 18.26. Close enough. So we get rid of these lines. We get rid of these lines. And so it's funny because if you look at the account, it actually says that we're down 5%, right? If you look at Kohl's, it's going to tell us that we're actually down 5% because our cost basis is $20.05. But as I showed you, we didn't put any extra money into this account. We just started with the 7,500 and then we just been writing calls, writing puts, collecting dividends. That's all we've been doing. I didn't add any extra money into this account. So all those extra plays that I've been making, selling the calls and collecting dividends, that's actually going to lower my cost basis. So I didn't pay $20.05 because we made more money off these shares and I didn't put any money into it. So that lowers our cost basis. As you can see, our cost basis says right now it's minus $5, or sorry, minus 5.5%. But if we actually compare it to the real cost basis, which is $18.26, again, from all the dividends and the calls we've been writing, we're actually up 5.5%. So I like that. I like that. I like that a lot because I think the last time we talked about what was going on at this account, I think we were like Coles kind of just dumped all the way down here, and I was saying that I want to see a bounce out of this zone because under here you can see that they're accumulating kind of thing because price seeks liquidity. Liquidity is can be everywhere. It can be at recent highs, it can be at recent lows. In this scenario, liquidity is at recent lows because price dropped down here, and you can see a few days after just consolidating, we immediately started spiking higher. And now we appreciated all the way back past my cost basis. So what I've been doing, to go back to kind of getting everything up to speed now. The latest play that I've been doing was to try to just write calls. Yeah, literally just write calls on calls because now that we're back above our cost basis, even if it gets called away from us, we're still going to be making money, right? So we wrote a $19 and 5 strike um, expiring this week, which is I think Thursday. This Thursday the second, and yeah. So as you can see, we got paid 40 cents. We had 3 contracts because we have our 300 shares as collateral, and yeah, we got paid $120. So my goal here's my goal with Coles now. I like how we've been appreciating so fast. Like, I love this shit, right? Because Kohl's has a lot of potential. Kohl's has a lot of potential because it has a lot of real estate. It's valued. The market is currently undervaluing the entire business. Like the enterprise value, I think of Kohl's is like much higher. We can actually look this up right now. I think I have it on this tab. The enterprise value, which is like the value of the company should it liquidate every single part of this business, is much higher than the actual market cap. So that means that this company is severely undervalued. So as you can see, look, the market cap based on the outstanding share price, or sorry, outstanding shares plus times the share price, the market cap is valued at $1.71 billion, but the enterprise value is 7.67 billion dollars. Like, this is not a bad business by any means. So this is one of the metrics I like about it fundamentally. They have an attractive price book ratio, an attractive price sales ratio. They have an attractive PE ratio. The only narrative that's people are worried about this business is that they're declining sales from the past couple of years. But they made some new executive announcements and made some new executives to brought in like a new COO to kind of try to make amends to the sales. All of that to say, I'm basically bullish on this company for the rest of the summer. I want to see how the Q3 plays out. I want to see how Q3 plays out because you know most of the time people are gonna spend money at retailers in the summertime because like it's summer. Like why not? Like Sephora, I'm pretty sure they're gonna want to buy their beauty products and their makeup and stuff like that from Sephora. So I kind of just want to hold on to this and see what happens over the summer. And then I also am bullish on the market until the midterms because like if you want to win votes, you can kind of like if you want to win votes, you can kind of paint the facade that the stock market is the equivalent to the economy. And a lot of the times people think that like the performance of the stock market shows the performance of the economy. That's not true at all. It's like that's not really true. Like the stock market can be doing very well while the economy is doing poorly and vice versa. But I think that for just the way that the administration wants to play into mind tricks for people, it's like you can say the economy is doing very good if the stock market is doing good, and people will believe you. So I don't think that they're going to crash stocks or we're going to see like a major crash before November. So these are kind of just the bullish reasons why I'm holding on to Coles for now. Like I think my target price is around like $25. If I can capture $25 on the upside, I'd be happy with that, you know? Because again, our cost basis right now, after holding for like 6 months, playing around with it, we got our cost basis to 18.25. If we can appreciate to $25, that'd be a gain of about 37%. So, I'm not gonna complain with a 37% return, even if it takes a year, right? Like 37%, that's really good. So that's basically where we're at. As far as the current play that I'm in, which is the 19.5 strike. So we collected 120. My goal with this is really to just I don't want to actually get called away, so I'm going to try to close this out with about maybe 50 to 60% profit. So of the 120, if I can only collect at least like 60 to $80 on it, I'll be perfectly fine. I'll be perfectly fine. And so that is the pending order that we have here. So as you can see, we got paid 40 cents. We got paid 40 cents to write that contract. If I can buy it back for 9 cents or 10 cents, that means that we'll collect 30 cents on it, which means if you do 30 times the three contracts we have, that'd be 90 cents times 100. We'll have collected $90 from this $120 play. So that's the goal here because I really don't want to get called away at 19.5. I have 300 shares. And we've been seeing a lot of momentum in calls. And again, I think that momentum might continue on for the next couple weeks to months. So yeah, $25 is my go-to price. And then if we get higher than that, I mean, I'm not gonna complain, right? Like if we just take a look at the weekly chart, if this thing really starts to take off, I have this liquidity zone up here at around $32. And then, that'll be like the next target. So couple targets that we have. We can either I'm gonna start writing calls around the $25 strike, as you can see, or sorry, I'm gonna start writing calls around the $25 strike when we get up there. And actually let me show you the options chain. Um and then briefly talk about SMR and my plans with that, and then we'll get going. So basically we come to the options chain. Let's go to KSS, and then my laptop needs to I need to upgrade my laptop because it's moving very slow right now. And it sucks because Apple decided to freaking upgrade or increase the price on all of their MacBooks. And what are we recording on? A MacBook. Like amazing. Um okay, yeah, so we're gonna trade KSS options. I just want to show you the options chain because right now, our I know that I want to sell shares at $25, but it doesn't make sense for me to write that because we're not getting paid anything. So what I want to do is I want to sell a call, right? Current share price is $18.95. I want to sell a call for my goal is $25. So as you can see, the options price, the price of the premium on the options is going to be based on plenty of different factors. Delta, Vega, Gamma, Theta, Rho, right? So based on the current based on the current share price, and when I usually do options and I'm writing my contracts, I usually do either a week or two out. So I'm maybe gonna give it like a week or two. And I wonder about what's the best way to get rid of, or what's the best way to write calls against shares that you want to get rid of. I'm still kind of working around that strategy. Um, but yeah, so like, for example, if I wanted to sell a $21 covered call, I'd only be getting paid 3 cents. And remember, we have 300 shares, so you take 3 cents times 3, that'll be 9 cents. 9 cents times 100, you're only getting paid $9. I don't want to get paid $9 to sell my shares at 21, you know? I'd rather get paid a little bit more, but this is why you have to wait for the share price to increase more. Because if you can see, let's say I wanted to sell my shares at $18.05, which in all technicalities we could do that because remember, our cost basis, remember, from all the dividends, our cost basis got dropped down to $18.26. So if I decided to write this call $18.05, we can still make a little bit of money off the shares if it gets called away. And we'd be getting paid 83 cents in premium. So let's do this math real quick. 83 cents times 3 is $2.49 times 100 is going to give you $249. So I can get paid $249 to write this contract, but it would only sell my shares at 18.5 if it gets called away. You know, the beauty about options, or I feel like selling options, is you want to create scenarios where no matter if the option expires in the money or out the money, you're still good, you know? So technically, I can write this and still be good. Like if it gets called away, I'm still making money on the strike price and I'm getting paid a little bit of a premium, you know? And I mean, if we're being extremely technical here, if you do 18.5, you're not actually selling it at 18.5. It's like you are, but remember you got paid the 83 cents in premium. So you would take 18.5 plus 83 cents. So if I write this contract, it's really like selling it at $19.33 because you take the strike price and you add the premium into it. It's like selling it at 19.33. But I mean, you know, eight from 18.26 to 19.23, it's like I don't know, like what does that return? Let's see. I feel like we can get a much better return, basically, which is why I'm not going to write that contract. 1933, we could capture about a 5% return. But why do that when there's so much more, I think, upside that can be had? So anyways, just wanted to show you what the options chain's looking like. Uh my goal is $25. So as you can see, I would like to sell a $25 strike, but the problem is we're not getting paid anything, you know? It's like we can write anything we want to, but we would not get paid. And mind you, this is all for expiring July 2nd. You can always go further out. Like, let's see, I'm curious to see what 2 weeks out would be. I don't think that it'd pay you anything on the 25. Yeah, it still wouldn't pay you anything. And even if you go to $23, you still wouldn't get paid anything. So I gotta look, I gotta do some research about like what's the best, what's the most optimal way to sell, write a covered call when you actually still want to keep the shares, you know? Because I don't actually want to get called away. I feel like I don't mind getting it called away if share price increases to 25 or even higher. That's when I'm like, all right, I'm ready to sell. But Coles has a lot of potential. Coles has a lot of potential. So that's kind of where we're at now. Um, Over the weekend, we had a breaking news that Iran, or there's some new strikes on Iran. So maybe the market will drop. And so that's actually the cool part because the price that we're seeing on these options right now is based on the last close, which is 1926. But if you look at after hours, price came down into like 1880 something. So right now, my goal is to just be able to close out the call and make a little bit, collect some premium on it. So we'll see if we'll be able to do that this week. So we have the limit to buy to close. We'll see if we do that. And then right now, we're kind of just sitting on SMR shares. So briefly talk about SMR. Um, this is nuclear, and I feel like nuclear is very much needed to provide the energy for AI and these data centers. So here we are. We are down a whopping 15% on the shares. And I think this average cost is actually accurate because we wrote, I think initially we wrote like a $14.5 strike, and then based on the premium we collected, this might be the actual average cost of my shares for now. So if we go back to SMR really quickly, Yeah, or 12. Okay, no, 1207. Yeah, or 1204. Yeah, roughly around that. 'Cause I forgot I did sell some more puts and I collected some premium off it. So it was 1287. I think I brought it down to about 1207. Or sorry, not that I sold puts. I acquired more shares at a lower cost basis. So it brought it down to about 1204, 1207. So this is our current cost basis on SMR. And I don't know about this this thing has been ranging. I thought we found a bottom here, but it's kind of hard to say. It's kind of hard to say. It's kind of hard to say. You know, this thing doesn't really have a plan on generating revenue and getting their product out until like 2031. So this is very much a long-term play. But I think in the short term, like if you look at the weekly chart, this thing has been beaten up a lot. Like even if I am holding for the next 6 years, I don't think this is a bad place to kind of accumulate, you know? The only problem is I think that if this structure, let me zoom in here, if this current structure fails to hold, let me show you what I'm talking about. This whole structure down here. Let me get rid of these boxes as well. But if that entire structure fails to hold and we have to break lower, I mean, I can see it coming down into maybe the $8 price range. That would suck. That would suck though, right? Because remember, our average cost is around like I think I have it here, $12. Yeah, our average cost is $12. I mean, realistically though, I can see it coming back down into $8 though. If I'm being completely real with myself, right? That would mean that we'd be down 32% to 35 to 40%. And isn't that exciting? You know? But here's the thing though. It's the same thing happened with Kohl's. Same thing happened with Kohl's where our average cost basis initially was at up here around like $21 or $20.05. If you take a look at that actually, we got a sign at $20.05 roughly there. We were down a total of 40% on Kohl's. I think the last update I made on this account, we were down like 40%, but now we're right back up to, breaking even. So this is what you gotta do sometimes. You gotta hold, you gotta play the holding game, play the long game. But that is kind of where we're at. Uh, just to wrap up here, we're trying to close our um close this position here and collect like maybe $90 in premium. That'd be cool. And then as far as the SMR shares, we're just holding on to that. And maybe I'll write some. So we do have some buying power. So maybe I will write some puts, some low, since we're so low, and try to maybe lower the cost basis or collect some premium. I'll see how that plays out this week. And then Coles again, just really I want to hold these shares until we get to around $25. I'll be ready to sell at 25. And then SMR, I don't know when I'll be ready to sell because this thing is so volatile. It can be up 10% in a day and then go down 10% in the next day. So it's very hard to kind of play around with it like that, like capture or have a target, especially since I thought we were going to break out from 14, but we didn't. So we're kind of just ranging. We're kind of just ranging, and there's no way to tell when we would break the range. So as for now, as long as if we can get above the cost basis, I think I'm just going to continue wheeling. Where if we get above $12, I'm just going to sell a call. Just going to sell a call, then collect those premiums. If it gets called away, we're selling at a profit. So that's where we're at, and then we're sitting roughly at 75, basically our initial balance. But remember, we're still actually up 13% from the money that we've been making from this collecting premiums. And I wish I could see my P&L. I'll find a way to do it on the next time. Testing retirement notifications. P&L, P&L, P&L. Maybe I'll see it here, reports and statements. No. Investing, equity, total market value. Why don't I have, why is it so difficult just to find the P&L? Investing, history. Anyways, that's our update. That's the update we have. We'll be back maybe in about like 2 weeks. Post another update, but that's where we are. And see you guys in the next one. Thanks for watching. Peace.